The market narrative is shifting from AI optimism to Middle East worries as tensions between US and Iran flare up again, and a key oil facility is targeted in the UAE. Yields are rising in reaction along with the US dollar, and equities fall with pressure on European indices exacerbated by renewed trade tensions with the US targeting the auto sector. At the same time, the spotlight remains on US technology earnings. Palantir's strong results yesterday after the bell failed to revive appetite, while AMD is set to test whether the AI-driven rally can withstand rising macroeconomic uncertainty and intensifying competition across the semiconductor space. So welcome to Swissquote's Daily Market Talk. It's Tuesday, 5th of May. I'm İpek Özkardeşkaya. We will talk about geopolitics, earnings, and more. But before we do, and as always, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So yesterday, the US announced it would escort ships through the Strait of Hormuz. They called it a humanitarian operation. How nice of them. Iran, in reaction, said that they would bomb if that happened. US reportedly once against that warning and escorted ships outside the Strait of Hormuz, and Iran bombed ships and a key oil infrastructure in Fujairah in the UAE. That was one terminal that could eventually avoid the Strait of Hormuz for exporting its oil, as it is just on the other side of the strait. Unsurprisingly, oil prices spiked. US crude spiked to nearly $110 per barrel level, Brent to $115 per barrel mark. This morning, uncertainty remains high, yet we see a slight easing in oil prices. Now, this pattern is similar to the earlier ones. The $115 to $120 per barrel range is again acting as a strong resistance. Above this level, the market shifts from pricing supply constraints to pricing demand destruction. And the latter includes rising inflation expectations, rising hawkish central bank expectations, and rising sovereign yields, all of which were activated yesterday. The US 2-year yield, for example, spiked near the 4% level, while the 30-year yield breached the 5% psychological mark. Here in Europe, a benchmark for European 10-year yield was higher as well. As such, the dominant market narrative flipped from AI optimism to Middle East worries yesterday. The US dollar index rebounded past its 200-day moving average as a reaction. Gold eased to $4,500 per ounce level as a stronger US dollar and the rising yields that increase the opportunity cost of holding the non-interest bearing gold weigh on gold appetite. I believe that for gold, the fact that we witness a speculative bubble right into the Middle East crisis is also responsible for the strangely poor performance during this latest geopolitical crisis in the Middle East. But gold remains an excellent asset in the actual geopolitical setup. This is why central banks are said to be amassing gold as prices retreat. So cheaper gold is still very interesting for long-term portfolios. Elsewhere, the Reserve Bank of Australia delivered its third straight rate hike today, in line with expectations to rein in on inflation. The Aussie dollar eased nonetheless, despite the hawkish RBA decision, pressured by a broadly stronger US dollar across the board, a result of rising geopolitical tensions and rising oil prices as well. And the euro dollar is testing its own 200-day moving average to the downside this morning, while the dollar yen consolidates a touch below its own 100-day moving average, with the Japanese yen bears somehow scared of further FX intervention. Now, the FX moves will likely be driven by the US dollar in the coming hours and the coming days. The higher the tensions in the Middle East, the higher the oil prices and the higher the US dollar. The higher the US dollar, well, the higher the inflation expectations for the rest of the world that buy the more expensive oil that's also denominated in a stronger US dollar. And the higher the inflation expectations, the higher the call for central banks to raise their interest rates to tame these price pressures and the stronger the hawkish expectations for global central bank policies, the lower the appetite for risk assets. As such, major US and European indices retreated yesterday. The Stoxx 600 index also got hit by a notable sell-off that we saw in European car makers on news that Trump would slap 25% tariff on them, arguing that Europeans do not comply with the trade pact. But what trade pact? The tariffs were ruled illegal just a few weeks ago by the US own Supreme Court. But beyond the tariffs and the trade war, which no one knows is a thing or is not a thing, the problem for the European car makers is that they can't really replace the US market right now, because the US is pushing back against the Chinese EVs. And their car market, as a result, will likely remain as obsolete as the Europeans. But outside these markets, they are left to become increasingly obsolete by pushing back the Chinese competition for survival and not being able to lead the EV technology, while other parts of the world, like Asia and Africa, for example, will likely opt for this transition towards electric cars led by the Chinese, cheaper and kind of luxurious models. And of course, the longer the Middle East tensions, the higher the prices at the pump, the faster the EV transition. So to me, the European car makers are in trouble with or without the US market reach. But without the US market, the unraveling will be faster. As per oil prices, I believe that renewed tensions and damages to key oil infrastructure in the Middle East will keep the upside pressures tight. Depending on the developments, we could at some point see a spike above the critical $120 per barrel resistance. Yet I do not see a sustainable rise above this level, as when oil becomes too expensive, the demand softens to balance out the price spikes. Voila, that's it for the big picture. Now, the recent spike in oil prices keeps European futures under pressure this morning, while Nasdaq futures are slightly in the positive, leading gains this morning. Yesterday, after the bell, Palantir reported an 85% jump in its first quarter sales compared to the same time last year. The revenue was boosted by strong US military demand. Alas, good results and strong guidance from this AI play didn't suffice. The stock price fell in the after-hours trading on the worry that maybe all the good news around AI have already been priced in during the past few weeks' rally. But keep in mind that the technology stocks didn't say their last word just yet. Last week, we had strong results from cloud providers, including Google, Amazon, and Microsoft. And today, AMD will go to the earnings confessional with expectations pointing at a solid 30% or plus year-on-year growth, driven by AI and data center demand. Well, of course, here as well, the bar is quite elevated. After a strong rally, we are talking about more than 85% rise since the end of March here in AMD's stock price. The real question isn't just the print, it's whether AMD can beat convincingly, especially versus Nvidia's dominance and ongoing supply constraints. Nvidia, on the other hand, is feeling the heat these days of rising competition from AMD, but also from custom chips from hyperscalers like Amazon and Google. So far, none have matched Nvidia's full stack ecosystem, especially its CUDA software mode, which keeps it firmly in the driver's seat. But a shift is happening between training and inference since a while, inference being running the already trained AI models. And keep in mind, training large models remains compute heavy, complex, and deeply tied to Nvidia's ecosystem. But inference is quite a different game. It's about cost, it's about efficiency, and it's about scaling deployment. And that's where competition starts to worry. Think of Google's TPUs or Amazon's Inferentia chips designed specifically for inference. Anyway, let's see how AMD earnings will resonate across the stock price, across the broader industry, and across the broader financial markets, and whether the latter could continue to help mask the geopolitical mess for some more time. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market commands. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.